Okay, so let us begin. Good evening, Shivam, and good evening, everyone. And then, so any questions? Any questions? So, any questions anybody has? Can you please explain the valuation method in Material Master? That is our topic. So this topic, which we're going to start today, is going to describe the valuation method in detail. In fact, that is the topic we're going to start, valuation method. Any other questions, concerns? Any question, concerns, issues, challenges, problems, difficulties in the life? When I say life, I mean SAP life. I know otherwise you have too many issues, which I have no solution. Consignment warehouse. Consignment warehouse is basically is about we talked about where we send the material to the customer, and then it is lying in the customer location. It goes to the separate bucket. So it's like a special warehouse location at the customer site. So that is the customer consignment. Okay. Anyone else? Anybody? Any questions before we go to the next topic? Okay. So we can continue. And so today, we're going to talk about a new topic that is called valuation method. Valuation method. So when we go to Material Master, so if I select a Material Master, then here in the inventory data tab, we have a field that is called valuation method. So this is the field, valuation method, which we have in the SAP. Okay. So what does this valuation method field does? So that is what we are trying to understand. Your voice is not audible. Oops. Can you guys hear me? Is my voice coming to you all? Is my voice okay? Audible? Okay. Your voice not audible. Away, you have to check your system. You know? If my voice not audible, that not necessarily means something is right with me. So you have to make sure that your audio option, your system, your internet speed and all that is also okay. So here we have something called valuation method. In the valuation method, we can have a different valuation method. And one of them is moving average, and there are others as well. So we'll discuss that what does this valuation method do? how does this valuation method works? So we'll take some example, and using those example, we will talk about these valuation methods. There is also something called perpetual and non-perpetual inventory. So make a note of these terms called perpetual and non-perpetual inventory. We'll talk about that as well. Okay. In SAP, we have a different valuation method. Okay. And the valuation method is moving average valuation method. And here you will see that moving average valuation method. You can also have a standard cost valuation method, that is second option. Then there is a third option, which is called FIFO. FIFO means first in, first out. Three choices. There is one more. What does these valuation methods do? What is behind these valuation methods? How they're different? Okay, so we'll talk about that. Your voice not audible. Okay, nice. Okay. So first and foremost, we understand something called perpetual inventory system. And then we also have something called non-perpetual inventory system. Make a note of these two terms. So far, what we have used is, we call it perpetual inventory method. Perpetual, make a note of that terms. And also, in the case of perpetual inventory method, if you make a note of here, inventory transaction affects both stock level and value. So in case of perpetual inventory okay. So perpetual inventory, update quantity at good moments, and update value at good moments. Understand this. And because there is a value, that is why at every that is why it's called perpetual. every good moment. That is why there was journal entry. Remember, we talk about those journal entries. So what was happening is, that is why, so far all the exercise which we have done, all the steps which we have done, in all of them, we have used something called perpetual inventory. Now, what is the non-perpetual inventory system? In non-perpetual, what happens is, affect the inventory quantity, good receipt and good issue, quantity goes up, quantity goes down, but stock value does not affect. This only affect quantity, not value. So in case of non-perpetual inventory, update only quantity at every goods moment. Okay. No value change. It does not update no journal entry, no value update. No journal entry. Okay. So here, no value update. No journal entry. Okay. So that is the two options. Make a note of these. Take pen, paper, kagaj, kalam, dabat. Okay. That is what we do. That is what happens. This is the definition. Setup for the perpetual inventory. In the configuration, in the configuration in the company detail, there is a basic initialization in the configuration in the administration module, and if this is active, then perpetual inventory is made possible. So where is that? So we close this, we go to administration module, we go to system initialization, company detail, and here we have a basic initialization, and here we have a small box, if you see my cursor, that is called use perpetual inventory. Use perpetual inventory. So this is a small checkbox. If you put this perpetual inventory box on, then this box is on. If your perpetual inventory is not on, then it will not be on. So where it is part of administration module, in system initialization, in the company detail. In the company detail, we go to basic initialization. In the basic initialization, we go to use perpetual inventory. So that is where we go and we find this button, a small checkbox. Your way of teaching is very nice. Sometimes you use idioms and phrases are best. Yeah, thank you. So this is the setup of the perpetual inventory. So this checkbox should be on. So there is a prerequisite. Only if this checkbox is on in the configuration, system will do perpetual inventory setup. Otherwise, system will not do perpetual inventory setup. Okay. Now we talked about monetary value of inventory posting. Now make a note of that term, monetary value. Now this is one thing which I emphasized a lot yesterday when I was talking to you, that there is a monetary value, which basically means then when we do the transaction yesterday, right? So we did all various transactions. In all of those transactions which we did, there is a monetary value. So if I go back, so for example, I want to go to some, let's say some purchase transaction we did. If you look at it here in the purchase transaction, and if I go to receipt here, okay, so there is a good receipt. Okay, yes, there is a good receipt. So if you go to good receipt here, if you look at carefully, then there is a journal entry. See that is journal entry. So finance is getting updated automatically, So finance get updated automatically. And then when I go to journal entry here, then what we see? You see that it's stock account. And this is stock account has been updated. This is the account number. This is general ledger number 1300, and its stock account has been updated by 12,000. That basically means when we did a receipt, this printer was for $12,000, and my inventory value has increased to $12,000. That is what this basically means. When you do a good receipt, value increases. When you do good issue, value decreases. So value increase, value decrease. Material comes in, value goes up. Material goes out, value goes out. So good receipt, value increase. Good issue, value decrease. And we saw that exercise. So a lot of these exercises which we did in yesterday also in class before, we did a lot of good receipt, good issue. We did a good receipt, good issue yesterday directly in inventory. We did good receipt with the purchase order, with the sales order also. With all of them, as I mentioned, there was a monetary value update. So that is why we have a monetary value update. So when we do good receipt against PO, value goes up. Then we do a delivery. Remember, we did delivery many times. So at the time of delivery, value goes down. So value goes up and value goes down. So at the time of very good receipt, value goes up. Any time of delivery, value goes down. So monetary value. And wherever you see the journal entry, in all good moments, wherever you see a journal entry, that basically means there is a change in the value. So there is a change in the value. Now in the standard SAP, we have, okay. Okay. So inventory valuation method, moving average price, there is a first in, first out, there is a standard cost, and then there is a serial and batch valuation. moving average price. Now we see here, if I close this, if I close this, I close this, I close this. Now let us say I want to go to item master. Let me look at the item master and select any of my material, for example. So this is the material, right? So this is the material we are using. And in this material, if I go to item data, and we have a valuation method moving average price. Okay, how does it came? We have no idea. So we go to item master. So if I click on if I create a new item master, and in the new item, let us say I want to create a material FG05. I select material group FG. Okay. So if I go here, if I go to data, then valuation method is moving average price by default. Now this is defaulting from item group. We're going to see that where it is. And if I go to drop down, then we have a moving average price, standard, and the FIFO. So these are the three choices which we have in the system. Your screen is running very slow. Please check your internet speed, right? Okay. Check your internet. Maybe that is the issue, because everybody can hear my. Okay. Your screen is running slow means what? I'm not moving a screen all the time. Sometimes I'm just on the one screen, right? So I'm not moving the screen all the time. And here we have an inventory valuation method. The first is called moving average price. Then we have something called first in, first out. Then we have a standard price, and then we have a serial and batch valuation. Serial and batch valuation is only available for this material which is serialized and batch managed. Now, what is serialized and batch managed? That is the next topic. There could be some material which is subject to serialization. There are some material which could be subject to batch number. So this is basically the fourth option is only available for those items. So we have these three options: moving average, first in, first out, standard cost. Now what is these three are, and then what is the difference between these? So moving average price is basically a weighted average. Okay. So what is the weighted? So moving average price, how does it work in terms of calculation? Okay. So moving average price is weighted average. Okay. So moving average price is the weighted average. Now what is the weighted average mean? So weighted average basically means, let us say I purchase 10 items at the cost of 10 rupees per piece. What is my total value? 100. Then I purchase another 10 pieces, and that I purchase at the price of 15. So what is the inventory value? 150. Now what is the weighted average? So weighted average is 250 divided by 20, 12.5. So that basically means in case of moving average price, system keep doing a weighted average. So when system evaluate your inventory, it takes the weighted average of all quantity and all purchase price and it updates. That is the small formula. If you want to make a note, then please make a note of that as well. Okay. Make a note of it. This is the weighted average. Now the second one is standard. Standard price. Standard price, we set up a fixed price for a material, and that becomes the basis for all good moments. And price is fixed. So if we say standard price or cost of this item is 100 rupees, then it will remain 100 unless we change it. Now, in case of moving average price, it changes every good moment. So because it's a weighted average, so every time price is more, price is less. So, price keep changing, because this time I'm buying this item for 10 rupees, next time I'm watching for 15 rupees, another time I'm watching for buying it for 9 rupees. So price every time I buy could change. That is possibility. If the item which you're buying and if the price keep changing, then my weighted average keep changing. So for the inventory valuation, so that is why it keep changing. This remain fixed. In case of a standard price, we set up, let us say 10 rupees, then this remain 10 rupees. It doesn't change. You may be buying for whatever, plus and minus, it doesn't change. That is a fundamental difference. In most cases, in the real world, people uses moving average price. That is what most people use. Some people can use a standard price. FIFO is not that very common, but we can use it. Means it is there. Some people can use it in some particular industries where you want to have a separate segmentation of the material. So you can have it also, but if you look at the normal industry, a lot of manufacturing companies and all that, and most of it, if you see, then people will use moving average price. Because why moving average price people will use? Because in case of moving average price, it keeps changing. So every time you buy for more price or less price, it keeps changing. So because of that, and that is the case that people will use moving average price, because the weighted average, it keeps changing, it keeps updating. Then we have a standard price. Standard price, some people can use specifically for the finished goods. So for the finished good and all that, in some cases, people can use standard price. Now, which one to use? Normally, it is dictated by, commercial requirement, and every country is different, and a lot of country special requirement and all that. Okay, so we talk about moving average price. In case of FIFO, system create a layer. So let's understand this FIFO. So let's say you purchase 5 items for $10. So the first layer of the item which you're keeping is at the price of 10 rupees. Then we have another, we purchase 5 items, and then system keep track of the second layer, and that you may be buying, let us say, in $20. So layer 1, 10 rupees cost. Layer 2 is having 20 rupees cost. So make a note of both of these layers. So first in, first out. Now, why the system wanted to recognize that? So because it is first in, first out, so system keep track. So layer 1 was for $10 or 10 rupees. Layer 2 is for $20 per piece. So the 2 layer, 2 different price. And because this is a FIFO, that is why when I'm doing a good issue, system first will take first layer. When the first layer is exhausted, then it goes to second layer, then go to third layer, then you go to fourth layer. So that is why it is called first in, first out. So system keep track of each layer, and based upon the layer, then system also keep track that each layer is of what cost, and whatever the cost of that layer is, system keep track of it. So that is the example of a first in, first out, FIFO. It creates a layer. Then in case of a standard cost, as I described already, a standard cost does not change. A standard cost remains the same. So you set up a cost for an item, and whatever the cost of an item we set up, that cost remains constant. That cost does not change. We say the 10 rupees per piece is a fixed cost, it's a standard cost, and this 10 remain, and it only changes when we change this cost of 10 rupees per piece. Okay, so that is why we have inventory valuation methods. I've seen most people using moving average price in India. So moving average price, first in, first out, and then standard cost. Okay. Now this is example of the moving average price. So whatever price in the purchase order, 5 units, 100 each. So let's do an example. So I want to do an exercise for moving average price. Okay. So I want to do an exercise for moving average price. Just an example. So let us say I create a material just so we can have a fresh material. So we create an item. Then I want to create a PO, and then I want to create a GRPO, and then I want to verify journal entry in case of moving average price. Okay. Let's understand this. So let's say we create a material. So we create item master data. And we select finished good. And we create an item called FG06. So it's an item master with the moving average price. And we create, okay. So this is unit of measure, okay. And then we go to, and the valuation method is a moving average price, okay. And we save it. So material FG06 created. So what we did, we created a material, and this material is called FG06. Now for this material, I want to create a PO. So we want to create a PO. So what happens with the purchase order? So we create a regular PO, for example. We select any other vendor. We enter the item FG06. Is item master for moving average. Let us say this is quantity 10. And let us say I'm buying this for 100 rupees per piece. Okay. So we are buying 10 pieces and the unit price is 100 rupees per piece. And then we add. So operation created, we create a purchase order. Now we go to copy to function, then we go to go receipt. So we do a go receipt here. And then when we go receipt, there's a vendor, FG06, quantity 10, and then we have a price. We add. So 10 pieces, unit price is 100. Then we save it. Okay. So we create a regular go receipt. After that, we go to journal entry. We want to see what is going on with the journal entry. Now in the journal entry, what happened is my stock account, there are two accounts. Yeah? So stock account is debited. So what happened is in journal entry, debit stock account, and how much it was? This is for 10 into 100. So for $1,000. So it has billed for $1,000. And there is a clearing account. So there is always a debit and there is also corresponding credit. So here we have a clearing account. Clearing account is primarily for the clearing. Okay. That is what we see here. Now, I want to see the inventory stock of this item. If I go to inventory data, and what we see here. So what we see here is item 10 in the material. Available is, so stock is 10 pieces because that is what we have purchased. And then item cost is 100 pieces. Because in the PO, we entered 100 piece. So item cost set up as a 100 piece. Now, let us say for the same material, I want to create a purchase order again. So I select the vendor. I go to same vendor or another vendor, doesn't make a difference. Keeping the same item though. So we select the same item. I select the same quantity. Now this vendor is a costly vendor. Yeah, possible. His price is different. He says, my price is not 100, my price is 200 or whatever. But price could be different. Different vendor can give a different cost, different price. Or even the same vendor can give a different price at a different price at a different time. So the bottom line is, it is technically possible, it is very common situation that price keep changing, based upon various things. It is a common occurrence in industry, in a economy, most economies, specifically an economy like India, or it is true in others as well, where the purchase price keep changing. Sometimes it's this, sometimes it's that, it goes up and down, whatever. So it keeps changing. So this time, earlier it was 100, now it become 200. And then we add. So we added, right? So after good receipt, the next thing which you want to do is a GRPO. So now I want to do good receipt. This is my vendor. This is my item number. This is my price, $200, item cost, and this is now. And then I add. So 10 quantity, unit price 200, and I add it. Say yes. After that, I want to check my journal entry. Now, what is the value? What do you guys see? What is the value you guys see? What is the value? What is the stock value? Is there in front of you? What is the stock value we see? What is the stock value we see? Debit column. $2,000. So what happening here is the same situation, which is another example. So pay attention what I'm doing. Looks like you're not paying any attention at all, because what is written in front of you also you're not seeing. Here we have so here we had so this is another. Now in the stock we had 20 pieces. So 20 into 100, 2000. So here we had quantity equals to 10 and price equals to 100. Here we have a quantity equals to 10 and purchase price equals to 200. Okay. So this become 10 into 100, $1,000. This is quantity 10, my price went up. So my stock account is debited with $2,000. So that is how, in case of moving average price, make a note of it. Material valuation happens. Material valuation happens at the price in the price in PO. And that is why most people use moving average, because it gives a real picture. Okay, so it gives you a real picture, because what the price goes up, value goes up, price goes down. So whatever is the price of the purchase, so system do stock entry as per that price. Okay, so that is what system does in case of moving average price. Okay, is screen not in sync? It is slow. Which screen you guys are seeing? I use very fast speed here. Which screen you guys see? Yeah, my speed is very fast. So if it is not, then check your internet. It cannot be, because I use high speed. Okay, so that is the moving average price. And then if I go back here, and if you go to inventory, now what is the item cost? 150. Why it is become 150? Item cost becomes 150 because the weighted average 10 into 100, that is equals to 1000 . Then we have 10 into 200, that is 2000, and moving average price equals to 1000 plus 2000 divided by 20. So 3000 divided by 20, 150. So that is how system calculate your moving average price. That is what we see here. Item cost become moving average price 150. So that is how the 150 come back here. Now I want to do another exercise. So this is standard price example. This is the same thing we described, that how the fee works. Now, how does the standard price works? So we are going to take an example of the standard cost. Sometimes people do use the standard cost as well. So we take an example of a standard cost. And how does the standard cost work? So we're going to do the same steps as we did our, we're going to do the same step. And then we're going to verify how is the difference. So steps will remain the same. So here also, we had, we're going to create a new material. Okay. So I create a new material. So I go to item master. Now for the item master, I select item FG07 or whatever. FG07. Then we go to item standard price. Okay. Now here we have an item group here. So I select the item group, this FG epoxy, whatever that is. Now why selecting this item group? Because if you go to this item group, if we hit enter on this item group, then you will find that this item group use valuation method is standard. So it's a different valuation method here. Okay. So it's a different valuation method. That's why we are using this. Okay. So here I use my unit price, unit of measure, inventory data. You see the valuation method is standard now. So this time we are using a standard valuation method, standard, and we hit enter. Now see the message here. Standard cost is not defined. Create an inventory valuation document to define the standard cost on the company or warehouse level. So now what the system is saying that we have to create something called a revaluation document to set up the standard cost. You say okay, we hit okay. So we create a material FG07. So we create a material and we call it FG07. And in FG07, now I want to go to revaluation document. So here we have something called inventory revaluation document. So this is inventory revaluation document. I add the item, so let's say FG07. And I put an item cost, and this is standard item cost. Say I said cost of this item is 100 piece. Okay. So I'm setting up here 100 rupees per piece, and I say add. Okay. Operation completed successfully. So we set up $100 for this item. So this is FG07. This is my item. If you go to inventory data, now if you look at it here, is a standard valuation method. And what is item cost? Item cost is 100. This 100 we set it up. This is the manual setup we have done, that this item cost me 100 piece per piece. Then we close it. After that, I want to repeat the same steps. The same step which we did here, same step I want to do it here. So we did these steps here in the moving average price. So I want to follow the same steps what we did. So I want to create a PO for 10 pieces, price $100. Okay. So if I go back, I want to go to purchase order, and then we go to purchase order, and I select the vendor, and I select any of the vendor we want. I enter the item FG07, and then I select the quantity 10 pieces, and I put the price as 100. So my standard price is 100, and my purchase price is also 100. And I say add and view. After that, we create a go receipt, GR posting, So this is your posting for quantity 10 and unit price is $100 per piece. And we add. And we add. And now we go to general entry. So there is a general entry here. And its stock account is updated by $1,000. Why $1,000? Because the same setting, same thing. Now, I want to do this part, that my purchase price changed now. The same thing we did there. So earlier, my standard price was 100, my purchase price was 100. Now my purchase price, let us say, become 200. Then what happens? So I close this. Make a note of these. These are the two entries. And now that is the difference. And we go to purchase order. So we enter the purchase order. We enter the item. Okay. So we select the ECME, whatever the vendor and we select the same item FG07. And we enter the quantity, say 10 pieces. And let us say this time I'm buying 200. Price may change. Okay. So earlier price was 100. Item cost 100. Purchase price now changed from 100 to 200. Possible. Market changes, price changes. So we get a purchase order. After that, if we go to the Guru Street and this purchase order, so we have a vendor, name of the vendor, add, and say yes. So operation completed successfully. Now I want to see the journal entry. Now this is a journal entry which is happening. What is the difference from the last one? What is the difference, guys? So in this, in the last one, what is the difference? Anybody notice the difference? Anybody notice? So these are the entries now. What is the difference from the last one? Anybody notice the difference? So one difference is material variance. So that is a correct answer. So Gagan, that is correct. There is a material variance. What else? So there are two differences. One is this, you're right. Ronak is also correct. So both of you are right. So there is a material variance account. But there is one more difference. What is it? Look at a stock account. No, not that one. Stock account. Stock value is 1,000. So what happening here is, so what is the journal entry here? So we are doing this example. So this is the first one. Now we are doing another example. So this is another example. This is item FB7. Now what happened is, my quantity was 10, my price was 200, and this was not, so this was 100. So last time it was 10 into 200. This time it is 10 into 200. 10 into 100. 1000. So last time the material valuation happens, the value of the stock was 2000. Here the value of the stock is 1000. Why? Because it is standard. So material valuation, make a note of it. That is the fundamental difference. Material valuation happens at price in item master, not at price in PO. So although my PO price is 200, still it ignores. It takes the price which we have in item master, which is 100. And the second difference is there is a material variance. Material variance is basically means the difference between price and PO. Make a note of it. These are important. If you have to ever become SAP consultant, you need to know this. And these concepts are same in all across SAP, all across products, most ERPs. These definition doesn't change. They are industry standard definition. They are not SAP definitions. This is what happens in industry. It's the difference price in PO and item cost. So this is 200 minus 100 and then 10 pieces. So this become 1000. That's why the material variance is equal to 1000. Okay. So make a note of this and how both all of these, somebody was asking in the beginning, what is the different material valuation and all that is. So that is how the material valuation happens. Okay. I have two good news. Good news number one, class is over. Good news number one, we will talk on Monday. No class on Saturday and Sunday. So chutti. So for 2 days, chutti. Study, read, practice, and watch videos. Understand these concepts. So we're done for today. Thank you. Thank you very much. And I will talk to you guys on Monday. If you have any questions, thank you very much. Thank you all. Thank you guys. Okay.